How are you now? It's been the best start to a year, which is probably not a big surprise. I think you kind of predicted. Best start to the year for equities. And I now see even around the globe doing pretty well. So we're off of that corrective mode that we saw at the end of last year?
Yeah, you had three of the biggest selling climaxes I've seen in quite a while. It ended on December 24th. And you've been straight up. We thought the target area would be 2,600 to 2,620. With the resolution of, at least in the short term, of the government shutdown, you overshot that. But by our measurement of internal energy, the market's internal energy is used up. So we don't think it can spike much higher from here.
What is that,
think the lows
by
are
the
in.
way? Sorry, internal energy. What is that?
We have a proprietary method of measuring how much energy is built up in the market. It doesn't tell us which way it's going to be released, regrettably, either on the upside or downside. It just tells you that there's a bunch of energy in the market. So if a move gets going like it did off December 24th, that there's enough energy to give you a pretty decent move.
It's kind of like a coiled spring.
Exactly.
Yeah, no, I think that's about right. I mean, that's what we're seeing is that, cash levels got to really high levels by the end of last year, suggesting that the market was setting itself up for a nice rally. And today, those cash levels have come down a bit. I do think there are still areas, and you tell me what you think, but I think there are areas with a lot of internal energy, maybe more within the cyclical side of the market. So if you look at sectors like industrials, technology, what I think is really interesting is that any company with any news, good or bad, during earnings season has rallied.
Yeah.
So it's like all news is good news, especially for industrials, tech, even consumer stocks. Sectors that were left for dead by the end of last year have actually, I still think that there's relatively light positioning in those areas of the market. And, I don't know if your internal energy monitors are telling you those are good places to be, but that's what our work is saying.
Yeah, I tend to like energy and financials, believe it or not.
Yeah,
Two of the most out of favor
another
sectors from last year.
Yep.
So a lot of strategists that were at 3,000 for last year are now at like 2,750 for this year, which is, I always like the way that works. Yeah, where are you?
2,900.
29?
2,960.
2960.
Oh, you guys are really close on this. What about technology? I mean,
Yeah.
we saw in the last quarter a lot of top line misses, some of the big issues.
Absolutely.
I think China certainly affected Apple, as we know.
Yeah.
Caterpillar's going to report in a few days, and they're exposed to China about 10%. But going back to technology, where do you see in terms of the
upside?
Where's the upside?
I think that where we see the opportunities are really more in old tech rather than new tech. So if you look at, and maybe not semiconductors, but, some of these bigger, older, clunkier companies like software or hardware, where they're super cheap, again, given up for dead, nobody owns them. And, if we do see the economy not head into a recession, these stocks could do pretty well. They also have tremendous free cash flow, which I think is going to become increasingly valuable as the Fed continues raising rates and cash gets a bid finally. So I think that there are pockets of tech that look really good. I still see new kind of growthy tech that worked really well for the better part of this bull market. Those stocks are still overowned. They're subject to more governance risk, like data privacy issues. So there's lots of kind of issues around those stocks, and they're super crowded.
Just from a numbers standpoint, in terms of the composition of the market, the FANG stocks, the growthier tech, they're the bulk of the markets. Can we reach that target of 2,960, Jeff, if we don't have the participation of FANG? Because what we saw with Netflix is Netflix reported a perfectly decent kind of quarter, and the stock is down significantly since it reported earnings.
And sell the news.
And it's also crowded.
But can we reach the levels that you're projecting without the participation of FANG?
Yes, I think you can.
Okay.
I think that you got a rotational into other sectors in the cycle, if you will. And I agree with Savita. I think that the old tech is the place to be in technology. And I'll say it again, I like energy and financials. My dad used to tell me good things happen to cheap stocks, and those stocks are cheap.
Savita, you mentioned as the Fed continues raising rates. So I've been wondering about this. We've obviously taken back a lot of the kind of panic of December, and people said things weren't so bad. We haven't slowed down very much, but we're still reassured that the Fed's going to be patient, especially after the shutdown.
Right.
What's the process as the market kind of transitions from that? I assume you're thinking to saying, okay, maybe the Fed can get in a couple of rate hikes here. Can the market handle that?
I think it can. I mean, again, as you point out, it's within the context of okay growth, nothing too extreme. And the Fed has signaled that they're watching the data and they're not going to do anything that throws us back into, a market downturn. So, I mean, that's putting a lot of faith in the Fed. But I think that net, if you think about the next, not even just this year, but the next, let's call it 2 or 3 years, the cost of capital is increasing rather than decreasing. Credit spreads are still pretty tight. Interest rates are almost at all-time lows. So I think that the name of the game here is to think about cash-producing assets like dividend, growth stocks, tech companies with high free cash flow, and shift your allocation more towards those guys and away from companies that burn cash in order to survive.